In this discussion, we will discuss the discussion question of describe operating leverage. This is going to be a CVP type of analysis calculation, but it's not one that's going to be as familiar to most people. In other words, we could start off with this discussion saying that this is going to be a type of analysis that we will typically use with a CVP type of analysis, as we would with many of the discussion questions we've seen here. In other words, it's not a managerial, it's not a financial accounting term usually, or a calculation we have on a normal type of financial statement or income statement, but one that we would apply to in a CVP analysis or a cost volume profit analysis type of income statement, which is a contribution margin type of income statement, with those terms that we're probably familiar with at this point with the CVP analysis: the sales, the variable costs, and the contribution margin. The total contribution margin in dollars divided by the pre-tax income or net income is going to be the calculation of the operating leverage. What we're doing is comparing, we're given a comparison of the fixed costs and the variable costs, and that's going to give us our operating leverage. So once again, it's going to be the total contribution margin in dollars divided by the pre-tax income or net income. So that's going to be the bottom line number before taxes. The net income or income, net income before taxes is going to be our calculation: contribution margin in dollars divided by pre-tax income. The reason that this is useful, the reason this is a useful calculation to have, is it can be used to predict how changes in the sales will affect the pre-tax income. So we can use this calculation to make estimates and say, well, what would happen if sales increases or decreases? In other words, the sales being the top line, if we're talking about revenue, sales, what happens if there's an increase or decrease in the revenue or sales to the bottom line, to basically the net income type number? The degree of operating leverage times the percent change in sales will equal the change in the pre-tax income. So that's going to be our calculation to determine what that change will be. And note there'll be variance, of course, because if there's a difference between the breakout between the variable costs and the fixed cost, there's going to be a difference in terms of operating leverage. In other words, if we consider a situation where revenue is going to go up, what's going to be the effect on net income? If we're talking about a company that has a lot of fixed costs, then an increase in sales will have a more substantial impact than it will, meaning net income will go up more substantially at a higher rate than if we're talking about a company that has a lot of their cost breakout is in the variable costs. And you could think about this in terms of an example. If you're talking about something like a movie theater or something like that, and your major cost in the movie theater is just paying the rent on basically the facility of the movie theater. And therefore, if you have one person in the movie theater, you still have to pay most of your costs just for running the theater anyways, if that one person is watching a movie. Or if you have, 100 people in the movie theater, it still costs basically the same amount to run the movie. So in that case, if you increase the sales from one person to 100 people, then that's a substantial increase in sales. The fixed costs don't go up a lot, because it's not like I have to provide another movie theater for all these different people. And therefore, there's going to be a substantial difference in the net income, because a lot of our costs are fixed costs. If, on the other hand, we're talking about something where the sales go up at the same time, or we have more variable costs in the calculation, that type of business, say we sell some type of food item where basically most of our cost goes into the food item. If we have a cart, a hot dog stand or something like that, and we sell mainly the food item, then if there's an increase in sales, that's great, but it's not going to increase as much because most of our costs are variable, and therefore the variable costs will be increasing in relation to the sales price. Of course, we will be making a contribution margin on that amount. In other words, the sales price is going to be greater than the variable costs, but the variable costs will still be typically increasing along with an increase in sales. Whereas if most of our costs are fixed costs type of items and our sales went up, then we don't see that same kind of increase in all the other costs, because a lot of them are fixed and they should remain the same.